I'm Ryan Lightfoot-Brown of FundCalibre. We're joined today by Bertrand Cliquet, manager of the Lazard Global Equity Franchise Fund. Thank you very much for joining us.
My pleasure.
You invest in companies that have an economic franchise. Can you just tell us what this means and what sort of characteristics you look for?
The idea behind the economic franchise is to identify not only high quality businesses, but businesses that will have a superior degree of earnings forecastability. So we have 5 sources of franchise. Think about them as the secret ingredient of the recipe, which is the one item that will give them the ability to have highly forecastable earnings. So 5 of those, you have natural monopolies. Think about the National Grid in the UK. You have economies of scale, where your size gives you an edge from a pricing and financial productivity standpoint. You can be a network effect, where increased adoption of a product increases the value of the network, such as Visa or MasterCard. You can have brands or intellectual property that protects your products, or you can have switching costs. Ask any company that has implemented SAP, should they wish to no longer require the services of SAP, it would be highly disruptive to the organization. What this franchise and forecastability means is being able to predict the future with a narrower margin of error. In turn, that enables us to set an intrinsic value on these companies where we have much higher confidence than your average company. If you can narrow down the future earnings and cash flows of these businesses, it's just much easier to ascribe an intrinsic value, which help us have very, very strong financial discipline when we invest and buy and sell companies.
Okay, and do you have maybe a couple of examples of your top 10 holdings that can bring that to life?
Yeah, I think one of the most recent companies that made it to the top 10 is the Belgian brewer, Anheuser-Busch InBev. Mm-hmm. And Anheuser-Busch InBev has 2 sources of economic franchise, really. Some of the large brands that it has, but the size of this business. This is a business where being able to have a large scale of operations will give it the ability to be not only price competitive, but really generate superior financial returns out of this scale. And for us, the opportunity really arose towards the 4th quarter of last year, when the market grew concerned about the debt level of the business, giving us a superb opportunity to buy this exceptional company at heavily discounted prices. It became part of our top 10. The stock today is still over 25% below its peak, which is in stark contrast to a lot of high quality businesses that are, in our view, too expensive. The second example is IPG Photonics. Is the largest company that provides laser for manufacturing processes, so whatever material you want to cut, the likelihood is you'll have an IPG Photonics laser. And the source of franchise here is their intellectual property. We think that they have 7 to 10 years of head start versus their peers, and the attraction of this business for us was the 4th quarter sell-off of the broader tech sector. This stock fell almost 2/3 versus its peak, providing again the ability to invest in an exceptional business, taking a longer term view, but using a discounted price. Today the business is still at 40% discount versus its previous peak.
And you use environmental, social and governance factors, the ESG factors, in your process. Can you explain how you go about putting that in there?
Yes, I think our process lends itself naturally towards being very, very conscious about ESG. Go think about what we're after. We're after companies with a superior degree of forecastability, and as a result, environmental, social and governance element will be crucial. We use environmental and social and governance criteria in the filter we use to define the universe. So we use 9 criteria. Environmental and social will be in what we call external threats. One of the 9 criteria has direct implication to the portfolio and universe composition. We do not invest in tobacco companies because we think the societal implication of tobacco makes us unable to accurately forecast the prospect of those businesses in the long run. Governance is an explicit item, one of the 9. So these items are part of 2 of 9 criteria. They are equally weighted, so 20 out of 90 points will be directly dependent on environmental, social and governance element.
And you've got a four-strong team that manage this, but you're based quite far apart at London, New York and Sydney. How do you go about working that in practice?
So we have 4 portfolio managers in the team. We have been working together for the last 15 years, so there's been, and we've been blessed really with the exceptional stability of our team. We have another 2 members of the team involved directly in stock analysis, based in Sydney as well, and one of our colleagues in New York as a dedicated marketing specialist. And the way we operate is that each of us in the team has individual stock responsibilities. We are all involved into rolling up our sleeves, meeting the management of the company, relevant government authorities, and the work we do when it comes to analyzing company, financially modeling the company, valuing the company, is submitted to the other members of the team for a peer review process. Being scattered across the globe is not a problem. I think it is a substantial benefit because we are in direct contact with all the relevant sector specialists we have at Lazard that are as well globally distributed. And we have a peer review process that takes the form of a stock meeting. So every week, the work that we will have put forward will be reviewed, debated, discussed by all the members of the team through a conference call that obviously involves somebody staying up late or getting up early, but it has been working superbly over the last 15 years.
And of the universe of around 1,600 names, you've only got sort of 26 names, very concentrated portfolio. Does that make your fund more risky?
That's a very interesting question about the risk and how we really think about risk. So as you said, around 1,700 companies make the MSCI World. We think less than 250 actually is part of our global equity franchise universe. And this is our fishing pond. So we will accept to invest only in one of those less than 250 companies because we think they have the franchise attributes we're after. We will build portfolio between 25 and 50 names. For us, the way we think about risk is important. Valuation is a key source of risk, especially in current markets. As much as we would be very happy to further diversify the portfolio with more names, we will not do it at the expense of valuation. We think that investing and adding more names that are intrinsically expensive actually increase the risk of the portfolio, and we think therefore it is prudent to lower the number of stocks on companies where we think there is a very significant valuation appeal, and that's what we have done in the last few years.
And in the portfolio, you own a lot of European names. Why is this, and does Brexit concern you at all around that?
So the names we own in Europe will, for most of them, be highly diversified company. AB InBev is one example, a highly internationally diversified business that happens to be domiciled in Belgium. Essilor-Luxottica is one of the leader in the eyewear and glasses industry, happens to be domiciled in France and Italy. Brexit does concern us, brings a lot of uncertainty. The way we think about uncertainty is sometimes it just does bring a lot of opportunities. When the market grows concerned about risk, opening up a nice valuation opportunity, and therefore, again, you can go and buy an exceptional business at a discounted price. So what we will not do is invest in a very high quality business at a very high price.
And conversely, you've got very little in Japan. What's the reasoning behind that?
We have invested in Japan in the past. One of the last stock we owned in Japan was a laboratories business, Miraka, so high quality business. We've invested in a USS as well in Japan. The reality is when we build a portfolio, what we do is for those almost 250 companies, we have an intrinsic value or target price, and we simply compare the target price to the current share price. And we rank these opportunities in the order of decreasing appeal and focus the portfolio on the cheap stocks. And as of today, we do not find attractively valued stocks that happen to be domiciled in Japan.
Bertrand, that's been really interesting. Thank you very much for joining us.
Pleasure.
And for more information on the Lazard Global Equity Franchise Funds, please visit FundCalibre.com.